Welcome to Financial Perspectives, the podcast. Join the team at Foster Group and our expert guests as we explore a variety of subjects that could impact your financial life. We will cover timely economic and financial market news, a wide range of personal financial planning ideas, and investment topics. Ultimately, we want to encourage educated optimism and do our best to provide valuable insights to help you navigate your financial journey with confidence. Please stick around at the end for important disclosure information. More information about Foster Group can be found in our ADV brochure at fostergrp.com.
When people talk about the market, they almost always mean stocks. We hear about the big up days, the scary down days, and the names everyone knows. For instance, have you heard the word SpaceX lately? But there's a quieter, larger part of the market that does a lot of the heavy lifting in a portfolio. It's the bonds. Here's what most people don't realize. The global bond market is actually bigger than the stock market. It just doesn't make for exciting headlines. And bonds play a very specific role. They are part of a portfolio that provides the money when you need it. When life happens or when stocks are down and you don't want to sell them, bonds are what you draw on. Today we have the privilege of hearing from Warren Pierson. Warren is the co-chief investment officer at Baird. He comes to us with over 40 years of experience managing bond portfolios, as well as providing strategic leadership for his firm. But before we get to his insights and outlook, let's take a few minutes to walk through what bonds are, why they matter, and a simple but important concept that we think ties it all together at Foster Group, the Lifeboat. So what is a bond? Essentially, a bond is a loan. As an investor, you are lending to the government, a municipality, or a corporation, and in return, they promise to pay interest along the way and give your principal back at the end. For instance, you buy a $1,000 bond paying 5% a year. That's $50 in your pocket every year, and at maturity, you get your $1,000 back. Predictable, contractual, dependable. That dependability is the whole point. To appreciate how reliable bonds have been in the past, take a look at this chart. This is the U.S. Bloomberg Aggregate Bond Index going back to 1976. Notice the shape, a steady, patient climb, not a roller coaster. That's bonds doing their job, generating income and growing slowly and reliably over decades. This is what capital preservation with income actually looks like. Now contrast that with another chart showing the historical drawdown of stocks versus bonds. A drawdown is how far an investment falls from its peak before recovering. Look at the stock line. It plunges 30%, 40%, past 50% in the worst stretches. On the contrary, the bond line mostly hugs the top with shallow dips. This brings us to the concept of Lifeboat I mentioned earlier. Market volatility unnerves even the calmest investors. When the market drops, we want to hold things that keep their value. When it climbs, we want things that are going up, not just holding steady. So how do we get the best of both worlds? And how much of each should we hold? The answer doesn't have to be complicated. Think of your bonds and cash as a lifeboat. Here's why that matters. If the market is going down, the last thing you want to do is create cash by selling stocks. Growth assets need time to recover. To get good long-term results, history tells us to stay invested through the downturns. Your bonds are what make that possible. They buffer the near-term bumps, and just as importantly, they reduce the angst that pushes people into selling at exactly the wrong time. So how big should the lifeboat be? It's driven by one thing, cash flow needs. Picture a couple near or in retirement. Their paycheck is winding down and the portfolio becomes the source of income. We advise clients to hold roughly 8 years of distribution needs in their lifeboat. Historically, that level of cushion has been adequate to weather market corrections. If stocks or real estate fall, the lifeboat provides liquidity to live on while waiting for the recovery, so growth assets are not sold in a panic. This is where that drawdown chart pays off. The deep stock declines you saw aren't the problem. Being forced to sell them is, and the lifeboat reduces that pressure. Volatility is normal. Staying invested is the goal. One of our investment principles at Foster Group is to trust markets. Investors who make markets their allies have done well in the past. Now, what if you don't have any immediate cash flow needs and you've got a long time horizon? Then it may make sense to be more heavily, even entirely in equities. As long as you understand markets go up and down, Even then, having a little exposure to bonds earns its keep two ways. It can be used for rebalancing, and it provides diversification for managing risk. Don't get me wrong, bonds are not without risk. Bond prices are sensitive to changes in interest rates. When rates rise, existing bond prices fall. For example, if an existing bond pays 3% and a new bond is paying 5% because rates rose, the existing bond is worth a little less. And when interest rates fall, the reverse happens. Bond prices rise. That's why this last chart showing the Fed funds rate matters. You can see the path for rates points to easing, toward about 3.4%, based on projections from late June. The direction of rates is one of the biggest forces on bond prices. We saw an extreme example of that in 2022 when the Fed started raising rates aggressively to curb inflation from supply chain disruptions following COVID. In that year, we saw the drawdown in bonds keep pace with equities. This was a rare occurrence, but illustrates the sensitivity of bond prices to interest rates. All right, now that we've covered bond fundamentals, let's get some insights from Warren about his outlook for the bond market. Warren, welcome to Financial Perspectives. It's great to have you here today. Just to get things started, I realize you run a duration neutral strategy, but can you comment a little bit on your outlook for inflation and interest rates, maybe over the next 1 to 2 years?
Well, thanks. First of all, Gretchen, thanks for having us. It's great to be here, and we're privileged to manage money on behalf of your team for a long time now. I think, your question about inflation is a great one because there's, coming into 2026, we sort of laid out our outlook of, the landscape. There were positive things on the left side of the page that encourage us, and then, things that concern us on the right side. Our outlook for inflation was on the left side, the encouraging side. It looked like it was contained, not to the Fed's 2% target, but, 3-ish%, a little less than 3%. Then the war in Iran broke out. And obviously, oil jumped up to $100 a barrel, and it looked like it was going to stay there for a while. And, inflation expectations leapt up. And, I think you've captivated kind of what's concerned the market. Our outlook is that longer term, we don't think inflation is that much of a problem. There's a couple of things. Oil, I say that, but we were hedging our bets a little bit saying, but if oil stays at $100 a barrel indefinitely, all bets are off, because that ripple effect. Now we're seeing here where, when in latter part of June, it looks like there's some resolution. Oil has come back down, $70-ish a barrel, so more manageable. We look at a number of different inflation measures, and I think what's captivated the market was a lot of the consumer expectations, University of Michigan, or the consumer, sentiment measures, and those are reactionary, and those are people's emotions, is what they think, and you saw really high expectations. One thing we look at is what Bloomberg calls the break-evens. It's really just the difference between nominal treasury yields and tips. And even shortly after the war broke out, across the yield curve, the highest inflation expectation, when you look at the market's assessment, was only about, when it got up to about maybe a little less than 3.5% on the short end, and then still, below 3%. Currently, that, if you look at those break-evens across the yield curve, it's like 2 to 2.5%. So, I think that in AI, when you look at AI, the considerations there, we think generally that's probably disinflationary. But that's guesswork. So we think that inflation longer term, iron out the wrinkle of this Iran war, and it seems like it's maybe getting ironed out. We would think inflation is back in that 2 to 3% longer term. And we think, anything below 3%, we think is pretty manageable in terms of the markets. That's not something that's going to cause interest rates to rise dramatically. And the new Fed now under Warsh, will they scrap the 2% target? Time will tell. But between 2 and 3% is probably a good estimate of where to see it.
Yeah, that's a good recap. It's been an interesting year already, and we're only halfway through, right? So we'll see what the second half brings. Yeah. What about your outlook for bonds versus equities over the same time horizon?
Yeah, and it's interesting because when interest rates came up in 2022, rates have been held artificially low by the Fed, and then we had 2022. Rates came up, and we've been saying for the last several years, we think there's good value with the level of interest rates in the market. And then right now, we would still say the same thing. We said the same thing coming into 2026, into 2025. We've said, it's primarily the level of interest rates that's attractive. Yield spreads are very tight, near 25, 27-year tights, which is corporate spreads anyways, which is amazing because there's been a ton of corporate issuance. The AI data center build out, huge issuance there. The market has absorbed that. So we see good value, but it's primarily the level of interest rates. We get back to our portfolios. They're skewing higher quality. The risk profile is about on the lower end, probably as low as we've been. That's just reflective of, tight spreads and limited spread opportunities. And so, as a manager, we don't see anything that makes us drool, or we're not pounding the table. Wow, what great opportunities. And so it can be a little disappointing, but the great news for investors is you can end up with a very, attractive yield. The yields in our full market portfolios, Baird Aggregate and Baird Core Plus, are just a little bit below 5%, which we think is, in a historical context, is pretty good. But you can get there by not taking very much risk at all. So we think investors should be embracing the bond market. We think that the potential returns are going to be pretty attractive. And the higher rates that we've seen from, say, 2021 to now, we think are a bit of a headwind for other sectors. Now, having said that, companies continue to find ways to increase earnings. And so stock prices are really driven by earnings longer term. But we think, in a slower growth economy, AI might produce a bit more growth, but we still think, we don't think it's going to be an inflationary type growth environment. It might be harder to continue to grow those top line revenues and the bottom line, earnings. So when you put it all together, we think that the opportunities in the bond market relative to other sectors, investment sectors, look pretty attractive.
Yeah, that's a really good summary. And you may have already touched on this a bit, but do you think there's something that the bond market investors are aware of that maybe the equity market is missing? Is there a story there to tell at all?
I think maybe, I don't know if the other sectors have if it's maybe fully filtered through just that the cost of money is no longer free. And, I think some of the sectors, private credit and others, they're realizing that, we're, going back to 2020, 2021, money wasn't free, but it was, interest rates were really, really low. We're not there anymore. And so there's probably some repricing that's going to be happening, refinancing. I don't know if that is completely filtered through. And so, I think that expectations for, say, equities, private credit, were really geared towards that sort of low, near zero interest rate environment. I don't know if those adjustments, if those expectations have adjusted, given that interest rates are now, have a four handle kind of across the curve. So it sounds like the pathetic plea of a bond manager saying, bonds are where it's at. And we want to be very clear. We're not saying that investors are destined to lose money in these other sectors. No, we think investors can still make money in real estate, equities, private equity, private credit. But the higher interest rates are a headwind instead of the tailwind that was present for a fair amount of the prior decade.
You mentioned private credit, and we have some clients with private credit exposure. How would you discuss, or how would you talk about the impact that private credit has on sort of more traditional bond investing opportunities?
Yep. Yeah, and I think that what the market has appreciated is there's maybe a rediscover or refound value of liquidity in the market. And, I think some of the people that ventured into private credit, for higher returns, and I think they will be rewarded with higher returns over time, part of the trade-off is you don't have as much liquidity. And, we're seeing that with some of the private credit funds gating the withdrawals, and that can be a disappointment. And I think also I mentioned, with higher interest rates, there could be some repricing. I think one of the concerns that the private credit market has had, if the redemptions get to be strong enough, will they actually have to start selling some of these underlying loans or some of the underlying assets? And if so, that could result in some repricing, causing spreads in private credit maybe to widen a bit. Will that cause investment grade spreads as well, or in the liquid fixed income markets to widen? If they widen enough, you're not going to see private credit spreads widen 100 basis points and investment grade spreads, hold on. So I think that's a risk. Our base case is not that there's going to be some crazy explosion in credit spreads, but it's somewhat asymmetric. We're at 27-year tights. We don't think spreads are going to go that much tighter. And so what we've done is we're still overweight credit on a nominal basis, but we've taken more of that exposure shorter on the yield curve. On a duration-weighted basis, we're actually underweight credit a little bit, which is unusual for us. So it speaks of just the environment we're in. So we try to employ sort of an all-weather strategy. And so, if they're so far, the sort of the cracks in private credit seem to be more anecdotal. But, if ascribers to the cockroach theory, you see 1, 2, 3, suddenly realize maybe those anecdotes kind of translate into a broader theme. I don't think we're there yet, but, that's what we're kind of wondering, will that be the case?
Yeah. Is it the red herring, right?
Yeah. And I think people want to be cautious on that front, that this is not a time to be terribly aggressive on credit. As I said, the spreads are, the fundamentals on the investment grade side are still very good. So these tight spreads, while they're very tight, they are warranted by very strong fundamentals. But we'll see if those valuations continue to hold.
Yeah, fair enough. Just going back to the bond market then, what areas of the bond market are you seeing the most opportunities?
Yeah, and I said before, this isn't an environment where we're pounding the table, about or drooling about the opportunities. It's more about risk control. But one of the sectors that we've liked for a long time, and we continue to like, is financials, banks in particular. The banking sector, certainly in the U.S., we think overall is in very solid condition. And so the financial spreads usually trade inside of industrial spreads. That is not the case. Financial spreads after the global financial crisis had traded wider. They've come back. But so we still see some pretty good value. And we feel better protected. There's just better intrinsic protection for bondholders. I say that, take a big bank like Citibank. You can't take an A-rated bank and do an LBO and turn it into a single B-rated. You can't. The regulators won't let you do that. An industrial company, I'm not saying it's a good idea or bad idea, but it's a possibility. That's not really a possibility. I'm not saying that banks can't get themselves into trouble. But their ongoing raw material, if you will, is capital, is money. So they need to maintain those investment grade ratings. And so, given spreads are a little bit tighter historically relative to industrials, we think there's probably the potential for some additional tightening. Spreads look pretty attractive. A lot of that issuance is inside of 10 years where we want to take that exposure. So for a lot of reasons, we see pretty good value in the finance sector, banks in particular.
Yeah, that makes a lot of sense. The last question I have for you then is, what do you think is the biggest risk to the bond market right now?
Well, one of the concerns, long-term concerns we've had, Gretchen, is just the fiscal situation here in the U.S. And it's interesting, and I think that the breakout of the war kind of overshadowed that. We're getting to the point where we were running a pretty big deficit, a $2 trillion deficit, and that's on $5 trillion of revenue. So, as a country, we're spending 40% more than we're taking in. That's you can't do that forever. I think the markets will be very patient. But, we are getting to the point where we need to do something with the deficit. I think the general consensus, and this might be, our opinion might be overly optimistic, but I hope we're right, that with AI, it could increase productivity, it could increase economic growth, and then as we've done in the past, we can grow our way out of this. One of the concerns we have is our population isn't growing. And when you look at the growth potential of our economy, one way to look at it is, productivity gains and then also increases in your labor force. Past times, you think back to after World War II, we were similar, had a lot of debt, but then we had a population explosion. The baby boom generation came up, our population grew, and we had productivity gains. The early 80s, during the Reagan administration, we took on a lot of debt and we grew our way out of it. Our population is 50% higher now than it was in the early 80s. Right now, our population's not growing. Our workforce is not really growing. We're not saying that, AI could produce enough added productivity to boost the growth, but I don't think it's as easy as it had been in past times. So that's one of our concerns. Getting back to your earlier questions about inflation, I think the market, there is concern about inflation because if you're a big debtor, what's the easiest way to get yourself out of that? Inflate things, pay back with dollars that aren't worth as much as they once were. And I think you've seen that, gold has come back down a bit here, but, gold went from 2,000 to 3,000. I think that was more inflation concerns, but that run up, over the last 12 to 24 months from 3,000 to 5,000, it's now back down to 4,000. But I think some of that was the market saying, the dollar's been a great reserve currency, a good place to store wealth. With the fiscal situation, I think less confidence in the dollar, but also in the euro, other global currencies. we think that's part of the reason that gold went up so much, that people were storing wealth in gold, not just an inflation hedge, but also a good place to store wealth. Just concerned about the fiscal situation. It's not just in the U.S. If we were the only country doing this, I think our currency would be in the tank and the markets would be penalizing it. But the reality is most developed nations have taken on a lot of debt. And so the question is, can we grow our economy fast enough to pay down that debt relative to GDP?
Yeah, those are three warranted risks that we just need to keep an eye on, I guess. A little bit, probably longer lead on all of those, but...
Yeah, we think the markets will be pretty patient with the U.S. We've got a long-term good history of paying our debts and paying them on time. But, we are digging ourselves a bit of a hole here, and we've got to show some improvement. I always say deficits don't matter until they do matter. There's not some axiomatic level or time at which they matter. It's more just the investor's perception. So I think that's still brewing underneath the surface. We're surprised that it maybe hasn't been as big of a deal. We thought, that concern would cause the yield curve to steepen. And boy, we looked really smart the first 6 weeks of the year. But I would have bet a fair amount of money that yield curve is going to steepen throughout the year. But yield curve has flattened and pretty significantly since mid-February when the war broke out.
Yeah. Well, thank you so much for your time. We really appreciate it. I appreciate your outlook. Appreciate your wisdom on the fixed income market. So thank you so much, Warren.
Well, thank you. And thank you for your confidence in our team. And I'll assure you that we spend the vast majority of our time and energy just trying to figure out how can we eke out a little bit more over the benchmark and then compound that consistency and give you very predictable results so that your overall, asset allocation will work. So thanks very much.
As we wrap up, remember the role of bonds is not to generate headlines or chase the highest returns. It's to provide stable, predictable income and liquidity when markets become challenging. They're the lifeboat in your portfolio, helping you to stay invested through volatility. The amount of bonds you hold should reflect your financial plan, your goals, and risk tolerance. Ultimately, successful investing is rarely about making dramatic moves. It's about building a diversified, low-cost portfolio, staying disciplined, and trusting a well-designed plan. Thank you for joining us today. We appreciate your time and look forward to connecting with you again soon.
The previous presentation by Foster Group was intended for general information purposes only. No portion of the presentation serves as the receipt of, or as a substitute for, personalized investment advice from Foster Group or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content, will be profitable, be suitable for your portfolio or individual situation, or prove successful. Foster Group is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Foster Group is engaged, or continues to be engaged, to provide investment advisory services. A copy of Foster Group's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fostergrp.com/disclosures.